Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, right now, of course, people are watching portfolios melt down, pension plans in distress. What should we be doing right now? Is panic an option, or do you still have to keep a clear head here?
Well, yeah, panic's never good. Proactive, though, is very important. And this is something that I've spoke about a great deal in the past few years because the time to start thinking about, your risk management is not when you've lost a huge chunk of your money. And, you have to think about it then, but it would be a lot better to think about it beforehand. Now, because most people haven't done that and they've gone into this downturn blindsided once more, my point would be that they still have to have a look at what's going on in their account. I know that a lot of people, the strategy is to sort of not open their mail or not look at their statements or just assume that everybody's suffering and just sort of try not and let it bother you. The problem with that approach is that if it's a actual bear market, it lasts many months. It doesn't sort of have a bad month and then bounce back. And that's what I think we're into now. I think we're into the third cyclical bear market since the secular bear began in 2000 from the most ridiculous valuations at that time that equities had ever reached. And then they plunged by 50 to 70% into 2002-03. They recovered into 2008. They plunged another 50 to 70% into the lows of March of 2009. And then they recovered in fits and starts in the decade since, as we all know, but there were many rough patches in there, when the cycle started to turn down, when organic growth was faltering, when earnings projections were not looking rosy. And each time we had the central banks of the world step in and sort of prime the pump and force speculative behavior again, it really didn't do anybody any favors. It extended the rally. It allowed some insiders to cash out. It allowed, buyback frenzy to go wild. But it was really a dramatic misallocation of capital in that period. And we're now paying the price for that, right? So all these businesses that could have used that expansionary phase to shore up their cash and their fiscal strength and to, do a whole bunch of prudent things, diversify their business, all that kind of thing, pay down their debt, they did the opposite. So they expanded in areas which were not going to be long-term viable. They took on the most debt that corporations have ever taken on in the history of Canada and other countries. The workers did not participate to the same extent in the benefits and the increases in terms of wages, so workers took on a lot of debt as well to spend at a certain level, which was above their actual ability to do so. They reached for expensive real estate in the low-rate environment, as you well know. And what ended up happening, people lost their preoccupation with principal protection, which should always be the fundamental goal or focus of every soul that has money to lose. It needs to be on, how do I not lose first? And instead, in the last few years, people shifted from, well, I can't afford to be safe, is the thinking they took on. I can't afford to keep my capital safe because I need it to pay me more money. I need it to increase. I need a higher payout than I can get from safe things. This is a disastrous mindset, but this is where the world went. And so they bid up every manner of asset that produced any income, thinking they were somehow conservatively investing. And of course, the problem is that the industry rose to the challenge by churning out all sorts of dividend-paying, income-producing ETFs, funds, products, portfolios, all which were priced indiscriminate. So they were just buying whatever they could buy that produced an income, regardless of price. didn't pay attention to valuations or probable outcomes over time, just rosy glasses and hope for the best. Then they took all these same instruments and they put them into a whole bunch of different packages, and they put all these conservative names on them, like strategic income and dividend income and high yield and all this stuff, which was all marketing wrappers, right? Because the definition of risk is not the label that's put on it, but rather the price that's paid for it. And because the price paid for it was unreasonable, too high, not economical, people were taking on speculative grade risk and calling it prudent and conservative and income and all this stuff. So I kept warning that the leverage in the system was getting higher and higher and higher, and that meant that the prospects for a big blow up, a la 2008 style, where huge amounts of capital were vaporized, was growing very high. And of course, the people that didn't listen held and bought near the top, and unfortunately the retail crowd is always the last in and the last out. So they were hurt in the last two downturns. They stayed away when prices were cheap. In fact, were selling at the bottom of 2009. They didn't go back in till late in the cycle, and then they were piling in the last couple of years. Now all of that has been wiped out in one fell swoop, right? Within a month, we have losses across the board on all sorts of risk assets. And in particular, Jim, this is the point, mostly on the dividend-paying stuff. So the stuff that people were buying thinking that it was somehow, conservative, has lost the most. If you go down the list in Canada, it's quite shocking. So the preferred shares, which I've talked about on this show before, preferred shares are equity-based instruments. They're typically have been issued by corporations with no set maturity date. They're floating rate. They're not necessarily cumulative. All these things that are in the issuer's best interest and terrible for the buyer. And people put them in packages and ETFs and bought them for the income flow. Well, these particular instruments have now lost over 30% in just 1 month, not even quite a month. At the same time, things like the Canadian banks, the dividend-paying ETFs, they're all off more than 30% just in the last 3 weeks. And then on the corporate debt side, the same thing. People were leaving GICs and government bonds and going to corporate debt thinking they were picking up some yield there. But if you look at those instruments, they've also lost about 30%, 24 to 30% or so in the last month. And that, of course, is not a surprise. As I've explained many times, they trade with the equity cycle. So corporate debt, corporate securities, preferreds, and common shares, these things all expand when the speculative mood goes up, and they all crash when everybody's needing cash. And that's exactly where we are today. So, the problem is, as I say, this is not likely to be a bad month with a quick rebound. Not like even a 2009 style rebound, which took several years, if you recall, just to even get back the losses that people had. It took about 5 years, if they held from the bottom, to just try and ride that thing back up. Now what we're looking at is the prospects of a multi-month decline, a global recession that typically lasts a year, potentially two, depending on how this all falls out, and a stock market that is likely to have a very L-style recovery, which means, potentially go sideways from the bottom or take many years and a decade to recover anything close to the recent peak. In which case, it's going to be a very difficult time for people who have not prepared properly in advance. So there's a whole bunch of lessons to be learned in this. There's a whole bunch of smarter things that can be done. But right now, people have to look at what they have. They have to give a sober reflection. They can't hide and stick their head in the sand. Stockbrokers and advisors are all out there telling everyone that everyone's lost, that none of this was foreseeable, and that it's nobody's fault. This is classic, right? This is President Trump style. He was taking credit for all the gains in the last couple of years, which had nothing to do with him, which was all liquidity and speculative mood. And of course, now that everything's come back down, he's saying, it's China's fault or it's not his fault. No one saw this coming. That's all not true. We didn't see the particular thing that would be the catalyst, i.e. we didn't know it would be a particular virus from China, although that was always, a pandemic is always a potential risk factor in the world. But we knew that something would prick the bubble because the bubble was in everything and the reckless behaviors were everywhere. And the leverage was such that we knew that once that bubble was to burst, the corrections would be fast and furious and would take people very off guard. And that's exactly what's happening.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, is it time to reform and change some of the rules to the Canadian retirement plan system, RIFs, RRSPs, and so on, so people are more flexible if something like this happens or can deal with it right now?
Well, the flexibility is not the problem. The type of account itself is irrelevant. It's the things that people are putting inside the accounts. And I did see that there was this cry to extend the amount of time people can contribute to the plans, or slow the amount of funds that are having to be taken out. All of those, in principle, I don't have a problem with perhaps more flexibility around that. I think it's tragic, however, that this is the financial industry's response now because they did such a terrible job of managing risk for people, because they sold them risk at every price. They were all focused on collecting fees and commissions, and no one was concerned or worried about downside risk. And so they added zero value, and now they're trying to pass the buck by saying it was nobody's fault, and of course, now we need to restructure the whole pension system. Well, unfortunately, we do need to restructure the pension system because for 20 years now, we've done these extreme behaviors, indiscriminate buying, which leads to these big washouts and indiscriminate selling. And we've got deficits that have compounded. We had deficits before this, right, Jim? We had deficits in pension plans all over, notwithstanding the longest bull market that we had seen in the last 100 years. Notwithstanding all the liquidity and QE and injections and support and all this buybacks and nonsense that has gone on to try and get the price of these assets up, to try and catch up for the losses of the last two down cycles, right? We did all these extraordinary things, and yet the deficits were still 30% in most pensions. And so now what we've got is a third time where now the deficits will be that much larger, the population is that much older, more people are expecting to withdraw funds and living longer, and of course you've got these big holes. So the structure and reform that needs to happen now is a whole bunch of things. It'll no doubt require us to extend the payments in terms of pushing off when people are allowed to start taking funds out of pensions. It'll no doubt involve reorganizing the rules around RSPs so people can put in money longer, because people are going to have to work longer to catch up for the savings deficits that they've suffered from all these years. We've had this really, if you think of it, it's like a preoccupation with gambling. You know, if people's primary focus is how do I gamble and how do I try and win money gambling, clearly that's a whole different mindset than how do I work smart, spend less than I make, save, put away principal, compound interest, not lose money. These are the foundational aspects of how you build a financial plan over time. But because we've put all the chips on the gambling approach, now people are horrified to see that they've lost again. So really it's a function of, you know, now we're going to have to restructure. I'm hoping that we get some sober reflection here, because this is the third time this has happened in the last 20 years, right? And all of these were foreseeable. These behaviors repeated each time, and the readings that we were taking, the extreme risk readings, were similar in the last couple of years as they were in the prior 2 cycle peaks. And that's why it was so obvious and easy for anybody that was looking for it to warn about that, right? But most people weren't looking for it, and most in financial services are paid to not look at that. They're paid to sell risk. So that's why the system has been a complete gong show. So today we now have, we've got a month into this downturn and people are missing a third and more of their money. We're probably looking at another 4 or 5 or 6 months potentially. A bear market typically lasts 9 months. And in this kind of an environment with the uncertainty around how long the economy is going to be shut down here, it's not, let's make no mistake, this is not because of the virus, although the virus was the catalyst for this house of cards coming down. So this was always going to happen for some reason, whether it was a corporate debt implosion, whether it was an emerging market debt implosion. There was always going to be something that was the first catalyst to start this house of cards down. Now it's falling. And we're looking at the potential for several more months of a bear market, potentially. You could even get a year or 2 of recession in an environment like this. We saw, a 2.5-year decline in the 2000 to 03 debacle, and the world was not nearly as indebted as it is today, and the population was not as old as it is today in terms of Western consumption. So there's a lot of things that are worse today than they were in the last 2 cycles. So I think people should be prepared that we could see several more months. Now, I'm not saying you get 30% drops every month. You're more likely to get, a 30% drop, a big rally, perhaps a Fibonacci retracement style stuff, and then you get the next leg down. But a bottoming process typically takes many months, has a lot of fits and starts to it, and I think that we might be halfway through what we could potentially see to the downside here. So given those facts, which are historically supported when you have conditions such as these, I think it behooves people to have some thought and reflection. A plan B, right? If the plan A and if the one being recommended by the advisory community is don't look, don't panic, don't worry, surely this will all bounce back. Let's look at a plan B for what if it takes many more months and it doesn't recover for several years after that. What is your plan? And if you don't have any meaningful cash set aside, don't let people talk to you about the buying opportunities of all this. This is classic. They talk about, this is great buying opportunities. They say that every single day, but they never advise that people sell near the top or when valuations are extreme so that they have meaningful cash set aside and kept dry for these buying opportunities, right? So this is the other major problem. And the second thing is, the way that a bear market moves, it is so brutal and ground out over time that by the time it is actually a great time to be buying, most people are not at all interested in that, right? They've just been hurt so bad that they're just no one thinks it's a good idea. The better way to do it, of course, is to be proactive in measuring risk to start with. Make sure your top-down plan is portioned properly so that you have buckets of money for different purposes, that you never have money, for example, for your housing in the stock market or for other goals in the stock market, and that you're very careful around what allocations you ever put into these risk buckets and at what price and what your rules are. These are all things that can be done to greatly increase your odds of not losing money and of having cash to buy when everyone else is selling in panic. It is possible to do it. We've done it now over the last 20 years. This is the second cycle that our clients have not had to lose money in bear markets like the masses, and then we have our buy targets ready to go, just as we did in the 2009 cycle. And you are able to pick stuff up at a great valuation with much higher yields, and that'll set you up for the decade after that. But it requires a lot of personal discipline and work and thought before, not panic and reaction during.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, one of the items on your blog, Juggling Dynamite, was it's never too late to learn from your mistakes and make better choices. People still have time to maneuver and look after themselves?
Well, in the scenario that I'm describing, Jim, they're going to have many years, very likely, to reflect on what they did or did not do at this time. And the last thing you want to do, and this is the classic pattern, is to do nothing all the way down. As I say, retail is always the last people out. The mom and pops who buy in late and are sold a bill of goods from risk sellers telling them all they have to do is hold these sticks of dynamite and it'll all work out. They then inevitably panic near the bottom and cash out when they're, to losses. And then those leave permanent damage, right? It's almost impossible to recover after you do that. But it's not a good plan, in my view, to say, well, you're just going to stick with it and not worry. Not if it takes many, many months and 50% drops, et cetera, to finally find a bottom, and then you're trying to recover for years thereafter. It's not an efficient way to do it, and people don't have enough time for that. So, as I say, this is the third time we've had this cycle in the last 20 years, and it's never too late to devise a better system, right? To figure out a better way to control your risk and to prosper given the cycle at hand. It's never too late. You can always figure out something, that you coulda, woulda, shoulda, but more importantly, constructive in steps and approach for the future. So I think it's always important to look for the upside, to look for what I can learn, what I can improve. But, obviously the problem with the human psyche is, as you go through a very traumatic loss cycle, you become very weak mentally, emotionally, psychologically, not just financially, and then it's very difficult for people to recover from those episodes.
I remember we did a show where we talked about what if things go sideways, what should you have done? People facing, close to retirement should, make sure you pay down your debts. Try to make sure you have a plan to live within your means, because once you're on your pensions, you're not going to be making as much money. So have frugal spending plans and so on. Was that the advice? If you followed it, you would be in good shape today.
Well, this is the thing, like the sudden stop in the world economy is disrupting revenue and income, right? And then, the capital that people do have, the savings that they do have, which is less than they should have set aside while working, because most people were spending too much relative to their incomes, taking on debt, which defers your ability to get net savings for many years if you've got lots of debt. In Canada, of course, huge mortgages have been a big problem because people have spent 30 years just trying to pay down their house, and that defers their spending in a substantial way for decades beyond what it could have if they'd been able to have more affordable housing. So all these things have, impacted their ability to have a disciplined savings plan. And so this has pushed them more towards this gambling mentality with whatever they have set aside. And so, of course, what happens is you come into these shocks and people don't have very much in terms of liquid money. So I've touched on this before. The even corporations, well, there's a couple of problems here. One is small business oftentimes has very tight margins to begin with, so a significant downturn in revenue or a shutdown is very hard for them to absorb. The way that you can help defend in a countercyclical way is to manage during an expansion or business period to pay down your overhead and debt, reduce your expenses, and build up your cash buffers. That is always a good approach for whoever can do it. And then the second thing that larger companies have done this cycle, which has been just epic, and it'll be written about in the books for years to come, is that they squandered incredibly high cash flows by buying back their own shares as a financial gimmick to, not just oil companies, although oil companies have been classic. They've been placating their investor class by paying them dividends and wasting money on buybacks to push up the price of the share rather than reinventing their business model, right? So now they're in this treacherous time where prices in Canada, oil prices, for example, are at 18-year lows. There isn't really any oil that's being produced in Canada at the moment that's actually profitable. So we got a huge problem now because there aren't any cash buffers in the system, or very little. And the same thing has happened with households, right? So they haven't been able to set aside enough in liquid savings deposits and GICs, things at the bank, so that if they have interruption in their income or can't work for a bit because they're sick, that they have some money to draw on. And so right away, because of this crisis state, this illiquid state, undersaved condition, we have now very little economic resilience, and people are, within a month, we've already seen people are not able to pay their rent, are needing mortgage payments to be skipped. The issue there is, of course, the government is now going to help with that in terms of deferring some of the payments, and that's all fine and well, but it doesn't replace the lost income, and it doesn't deal with the fact that most people have far too much debt. So I think we're going to go through a debt reconciliation period in this country now. It's been long overdue. Australia's in a similar fix. They recently cut their overnight lending rate to 0.25 in the banking system. I think Canada's headed there next. We're the poster children for the commodities boom turning into a housing obsession and taking on huge amounts of consumer debt, all of which made our economy much more weak and unable to absorb any shock of any kind. And now we've got a whammy of a shock, right? So the thing here is that there's a lot of debt on a lot of books of lenders, which is likely to be written down because you can't pay back money that's impossible to be paid back. And once asset values go down, people are forced to sell whatever they can to try and pay bills, and it's sort of a self-perpetuating cycle on the downside. So, yes, the lessons from this are going to hopefully be that we don't have, indiscriminate buying of anything at any price, that people go back to basic habits of discipline and not spending too much and getting their debt down, that lenders take a whack because they have to learn that you can't just lend, without any concern about whether the person can actually afford to pay you back, and then assume you're going to get bailed out by the government. This whole socialism for corporations, and banks and finance and all this whole sector that's become, really, unskilled and lazy in their price assessments and their risk assessments because they've been bailed out so many times. At some point here, we need to have discipline. The whole talk about, for example, the airlines, we've talked about this, have been through a decade where they saw a doubling of air traffic in the world. They've had an extraordinary period thanks to credit. Thanks to free credit, they were able to borrow a corporate debt side, and thanks to households levering up on credit that they shouldn't have spent in the first place. But we had this huge boom. Notwithstanding that, they are now in terrible straits just in, a period of a month of disruption. And they're looking to the government for bailouts. The government should not be bailing out organizations that manage themselves with insufficient buffer. So yes, we're going to have airlines, but I don't think the government should be bailing out these sectors who didn't see their own way to manage themselves properly for a shock of any kind. And so we will have, if you let the bankruptcy process take over, what ends up happening is you get a consolidation and you get strong players who have cash, who know how to manage, who know how to pick risk, who go in and actually pick up assets cheap and then turn it around and start an industry that's sustainable from there. So things like the travel industry, cruise ships, that's a joke. We shouldn't be bailing out cruise ships. Most of them pay no tax, and so we should not be using government money or taxpayer money to try and bail out a sector that's avoided tax for years. I mean, this kind of mentality has to go, right? This is the era we've been through. And now that central banks are out of bullets, and it's quite obvious because they've literally thrown the kitchen sink at everything they could in the last few years, and now they're left with a couple of plugs, right? That's all they got left. And they're still throwing the plugs, and the market looks at it and goes, oh no, you're not the Great Oz anymore. You're not magic. You're just a couple of people trying a bunch of things. So we pull back the curtain and we realize that these financial gimmicks have done us a lot of harm and that they're not helpful in the end. And I think we go into a new period where people go back to basics and start getting a lot more practical, a lot more self-preserving, in terms of how they're managing risk, and a lot less tolerance for this bailout mentality.
Danielle, thank you so much for chatting with us.
Hey, thank you. Good luck to everyone. I know it's rough, but I say, there's lots of good can come of this. I wish everyone well with their health. I realize that's a major concern for people. And that's why I say the health stuff we can only do so much in terms of keeping ourselves well and hope that we come through it well. But the financial stuff, we can actually help our trauma or reduce our trauma a great deal if it's managed properly. So it's next to health, managing our wealth is the next most important thing.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website, jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.